Good morning. It is about 30 minutes before the stock market's going to open. Let's have a live stream and talk about today's stocks and what we expect from today's trading. It's was a very pleasant day yesterday with stocks rising for all three indexes. The Nasdaq rose nicely, 1%, although it's had a tough 5 day and a tough month. It was good to see that relief rally. And it's expected that the futures are going to open up higher with the NASDAQ opening 1.4% higher, S&P 1.1% higher, and then the Dow 0.8% higher. So as we head into the day, I'm a little skeptical that these gains are going to be kept throughout the day. I think it's going to be a high open, and then it's probably going to fade, and it might even go into negative territory later in the day. We'll see. And that's a guess on my part, but I'm just kind of looking at what story is causing stocks to rise today. I can't think of one. And on the flip side, Airbnb announced their earnings yesterday, and when I look at that stock now, did they come out with an earnings that just blew away the previous numbers? No. Did they have a good number? I think so. They continue to grow their revenue. They're very profitable. They generated more cash than I expected. So all those things looked good, but their stock's selling off 13%. Their guidance was that they're going to keep growing, just steady growth versus just really hockey stick like growth. So to me, there's still like negative sentiment in the market where investors are very careful. There's still a lot of fear, what's going to happen. We're embarking on potentially a recession. That's all we're hearing now as we turn on the media and so forth. So we'll see how things play out. But my guess is that we're going to have I think a stock market that's going to open higher and potentially end in the negative by the end of the day. We'll see how close my guess is in today's trading. The S&P is faring better than the NASDAQ. It's got the big caps in it. Over the last 5 days, it's down 4.8% over the last month, almost 6%. And I think if you measure from the high to the low, it's not in correction territory yet. It's got close, got to 8.5. But as soon as we get to 10, that's correction territory. Now, I'm beginning to feel a little more comfortable about stock prices. You see that in this year, we had about a 5% pullback in the late spring. And now we're having another pullback. Okay, so now I'm feeling a little like, okay, some of these stocks have been kind of brought down a bit. NVIDIA took a haircut. I think Super Microcomputer has come up in the comments already. Super Micros, man, it's a falling knife. It's really bad. I'll cover it today and be sure to cover that one. But I'm beginning to feel a little more comfortable. Like, okay, so stock prices have taken a haircut. I think the market's spoken, which is, all right, enough of this, like stocks are just going to go up and continue to go up for no apparent reason. You got to put up some really good earnings to keep going up. At the same time, some stocks are just really being punished, which is a head scratcher. But if the stock market brings down stock prices on companies that I want to be an owner in, I just thank the market and buy shares. Thank you. I'm a bigger owner of that business. Thank you very much. So let me catch up on some comments. Looks like we've got some early activity. Thanks, everybody, for tuning in. I appreciate it. Shadow Guy, running a 24/7 operation in his investments. Thanks for tuning in. And then Do Me Trash. Good morning, sir, to you. And I'm glad to be here as well, sir. Ado, good morning. What's your take on the Super Microcomputer Open? I'm going to get to that. That'll be probably the first topic. That's an interesting one. Till the end. How you doing, man? Thanks for tuning in. Shadow Guy. A lot of algos bought on the dip. They programmed certain technicals. I think so. Um, you know, a lot of the trading now is kind of really algorithms and all these programs. I happen to think, use use that as an advantage as an individual investor. If you know that this, market is very programmed, then you can probably expect it kind of makes the market a little more predictable, and you can use that to your advantage in certain situations. For example, once we flip past a 5% drop in a market, it really creates a lot of havoc for all these programs because a lot of the stop losses are programmed around that 5% range. So knowing that, you're like, okay, as soon as we get to 5%, going from 5 to 10 is going to be pretty fast because there's going to be a lot of sells. So that's an item that I would bring up is just be aware that algorithms are out there. The world has become more pre-programmed, and let's use it to our advantage because I happen to believe that the human brain is going to be always more adaptable, more creative than any computer. And investing is both art and science. The science part's really important. Math, understanding fundamentals, statistics and so forth. Really important. But taking multiple variables and constantly changing variables in a market and using that to our advantage, that's where we can beat the computers in a way. So good topic there. Till the end. HIMS. I've looked at HIMS and I'll cover it today and I'll share my individual opinion on the company. It may take you a little bit by surprise, but I'll share it with you. Shadow Guy. So it looks like we are off to the races with the first thing we'll talk about is Super Micro Computer. And let's get into it. So Super Micro is a hardware company and they do high-end or high performance computing. And right now that is the craze, right? Hey, we got the data center build out. AI needs really fast computers. That's awesome. Yeah. You know what? Their business has really expanded quickly, but the company is not the stock and the stock is not the company. And when a stock price goes parabolic, and you're seeing my chart here, you kind of are getting, you're detaching from reality. You're detaching from fundamentals. You're detaching from revenue and discounting of cash flows. You're completely detached. It's almost like you're in space and good luck. And the stock is now just crashing or a falling knife. It's down 46% and it hasn't stopped dropping because the move up was so aggressive. You look at this stock in 22, call it a year and a half ago, is an $80 stock. Now it's $600 to $16. They're going to do a 10-for-1 stock split. So this will soon be $61, but and actually $530 on the open. So these are situations to me. And if you watched videos, I've covered Super Micro and my point of view. My point of view on NVIDIA, which is these are good companies. These are good businesses, but the business is not the stock price and the stock price is not the business. The stock price has detached from the actual value of the business. It's just at this point, a popularity contest, and popularity contests don't last forever. And you could see that the investors that are in Super Micro are beginning to head for the exits. I studied their earnings report and I filmed the video on Super Micro, edited it. It's scheduled to release tomorrow and you could watch it tomorrow. But let's take a look at the earnings. The earnings were very good. And again, when you detach your stock price, or the market detaches your stock price from your company, the company ends up putting up just a great quarter, and it's their fourth quarter. They have a fiscal year that ends, yet the stock price goes down now 14%. They have sales of 5.31 billion versus 3.85 billion. Just phenomenal growth compared to the third quarter, and compared to last year's fourth quarter, they more than doubled the business. I mean, that should be, if Meta or Microsoft had anything like this, their stock would freaking double like overnight. But so much hype and expectations, unrealistic expectations were set on Supermicro, that now, as we see the AI hype, right? When there was no like discussion of economy and recession and what happens in recessions, businesses pull back. They're like, hey, all these pet projects, cancel them. We don't want to do pet projects right now. Right now, we just want to focus on operating the business through this recession. So as that type of sentiment starts getting used, these companies are now put to a different test, which is how realistic is going to be, is the AI build out going to be? Is it going to last another year, another 2 years? There's no way companies can spend these amounts for the next 10 years. Meta, Google, Microsoft, AWS, they're probably going to stop buying at the levels they're buying. And that's like 40% of the business for this high-end computing. And other businesses outside of those businesses, why would they be buying into AI and taking a chance, a complete risk on a brand new technology that hasn't really been proven to be a business model yet? Few business models exist, and I don't think any of them are incredibly profitable. The ones that are profitable are the hyperscalers, the ones that are selling the capacity for you to build your AI models. So the thing that I point out with Supermicro, to give you a preview to the video that you're going to see, is that their margins are coming down. And that's a sign of a couple things. Is if competition enters the market, you're going to see margins shrink. Cash flow for Supermicro is negative in the quarter. It's been negative for the last 3 quarters. And the reason for it is they're buying a lot of inventory. And this is expensive inventory. You're buying NVIDIA GPUs and every other item. Well, if the market for the data center build out were to stop and Supermicro is caught with this inventory, that's really bad. So it's very risky that they're building up their inventory and could potentially be caught with very expensive inventory. This inventory, if it was expensive, and then let's say for some reason, hey, companies don't want to buy as many GPUs anymore, Supermicro would be holding inventory that could potentially lose value. And obviously it holds cash and they don't earn any interest on inventory. And in fact, it has a carrying cost, it has a negative aspect to it. So although things considered, Supermicro is a good business, and the stock price has been detached from fundamentals, from the actual value of the company, and now it's beginning to get corrected. So let's see where they're at this moment. Looks like they're down 14%. My short position on Supermicro, I did my valuation. Let me share that with you. And my short position, I'm up 32%, and I will probably close it today. I'll probably buy shares to cover and just take the gain. Now this stock price is a little bit off, but not too bad. I think it was 13 down, so it's probably even a higher premium. But I believe that Supermicro is being sold at a premium of 39%. And that's with giving them a very generous cash flow forecast. Right now, they're operating with negative free cash. And that's a big problem. You're generating negative free cash. And it's really hard to value a company in this position. Their earnings per share is really good. If we just use earnings per share, we get close to the stock price. So I think that's what a lot of investors and analysts are basing it on. The analyst, I'll point something out, and it's just my observation. It might just be an opinion more than anything. When you look at analysts and they're saying, "Oh yeah, this stock's discounted by 67%," it's like, guys, haven't you been paying attention? You got to update your reviews on these stocks because you're looking like you really don't you don't really care, or you need to update your analysis because this stock is obviously collapsing and they should update their expectations. But I think it, like with the AI hype, same thing with the dot-com bubble or any other craze like the metaverse. There's kind of a group think that gets started, and then all these analysts start to agree with each other. Oh yeah, the AI build out's going to be massive. It's going to be like huge, and it's going to last for 10 years. And people get carried away. So all their, work in a way gets kind of deemed to be unreliable. So with the AI hype, to me, charts like these give me an obvious situation. To me, this is obvious. This is a parabolic stock. No parabolic stock has ever seen its stock rise like this and just keep the gain, let alone rise like this and continue to rise. No stock. It's just not reality. So now this thing is going to come down. It's probably going to come down eventually down to like $100 a share, and it's going to be painful for many. I'm going to get out of the stock. A gain's a gain. Mission accomplished. When I started these shorts, I'm not a big short seller. I said 30%. If the stock rises 30%, which means I lose 30% of that investment, I get out, because I think short selling can really get ugly when people stay too long. If they had the wrong thesis, the wrong expectation, and that could really cost investors a lot of money. And it would teach me a lesson. I would pay a very high price, very high tuition fee for the market teaching me, hey, next time you think of doing this, think a little harder because I just taught you something. Okay, cool. Now, if the stock price drops 30%, sell, get it off the books. I did that with CrowdStrike. Mission accomplished, move on. CrowdStrike continued to go down, but at that point, I'm kind of risking, what if they rallied? Then I'd be like, oh, darn, I had that gain in hand. I should have taken it. So I'll close out Supermicro today. Those are my comments on Supermicro, and just reinforcing that I think the company is good. They're in the right business. I think the employees should be proud of the company they've built. All right, so let me make sure I'm catching up on. So N. Kiter, good morning, sir. Thanks for joining. So, do you think super microcomputer will drop 466 down to 466? So overall, eventually, yes. When? I don't know. Next week, next year, I don't know. I could just tell you right now, it's going to drop significantly, and I'll probably close this position early in trading. Today's trading, and maybe I could do a quick conversation because on the Discord, and I encourage everybody to join the Discord. Let me try to grab the link and put it on the live stream. In the Discord, we were talking about, going into the market. I think we experienced a dead cat bounce yesterday. We've had a declining market, and the market rallied, and it's kind of like, whoa, what is this? Like, the news hasn't changed. This is a declining market. So I'm calling it a dead cat bounce, and we'll see what happens. I might be proven wrong. But good chatter was around, well, at what point am I going to buy my shares today? Because I think that late trading is going to be when to buy for me, because I think the market's going to struggle to keep its gains early, and I'm going to buy late. And there was kind of different ways that people buy, which is great. You should fit the way you buy your stocks to the way you like to invest. Maybe, you have some strengths, always use your strengths. For me, I like to look at a market and kind of take it all in. Where are we at? Where's sentiment? Are stocks really being sold off today? Sometimes it's obvious, like the sell-offs we've been having, it was obvious, like Meta down 4 or 5%, buy. That's an automatic easy. That's the easy button. But on a day like this, do I want to buy early? No, I want to wait. I want this market to figure itself out. Like, okay, you've had so many down days and then you had an up day yesterday. I'm not convinced that we're going to continue to start to rally from here. So we'll see. So let me get that Discord link and put it on the chat here and show it on the screen. So join the Discord, because stuff like that, we talk about, and I think it's been really, really good thing. I appreciate whoever suggested it, and everybody kind of jumped on and said, hey, that'd be a good idea for the community. So I'm glad we're doing it. All right. So we're going to look at HIMS later. So back to Super Micro. We'll see how far it goes. But I'm probably going to get out and probably just watch as a spectator from that point. So any thoughts on what is a reasonable price for, so my reasonable price for Super Micro is $324 per share. That's substantially lower. And this number, I would not buy the stock at this number, because I'm using a very favorable cash flow forecast for them. Super Micro is in a low margin business. Hardware for technology, it's a low margin business. It's not like Microsoft that has 70, 80% margins on software. It's not Google that has just nuts margins, like 90% margins on their search. It's not Meta. Okay. Those businesses are super valuable because their margins are massive. The hardware business is very, very competitive. And that competition drives down margins, drives down free cash flow. So this would never be a business that is very valuable. Just study all the hardware companies. You'll know hardware, there's not a lot of value there. That's I think my rational target price would be 324, but even that number, I wouldn't buy the stock at. Okay. So that answers that questions. Aldo, thanks for tuning in. Have you ever been in a short squeeze? I have. So the short squeezes that I was a part of that I made money on was Big Five. And Big Five was kind of a fun stock. I ended up making money and then losing money on this stock. So back in the day, if you study from like in the the COVID crash, these guys obviously got sold off. And I ended up buying shares when it was being sold in the $2 range. And I was like, sweet, great. I bought some shares, maybe about $10,000, and it kept going up. And I'm like, man, this is great. And then out of nowhere, everybody started to short this stock, and it created this squeeze, and it went up to $43 a share. I sold all my shares. I couldn't explain it, sold them all. And I took maybe $10,000, $20,000 investment and cashed it out, because I averaged my buys, cashed it out at like 70 grand and walked away. And then it collapsed and it's never come back. Now, as it's collapsed like this, I ended up investing in the stock, and I ended up losing, I don't know, 10, 20 grand on it. But overall, it made me money, which is great. So that's one short squeeze. The other one was a REIT, a real estate investment trust. And what was the darn name of it? And it squeezed. And it was because it was a REIT. And I'm trying to go back in my memory because it happened in 21. But they're a REIT that had properties around shopping malls. And obviously after COVID, it was like, well, nobody's going to go back to the mall, and everybody, counted them out and they're going to die and go away. But they hung in there, and they actually squeezed the shorts at one point, and that one I sold and I made good money on. So I've been a part of those. I've never been, so now I'm not a big short seller, so I've never been on the losing side of a short squeeze yet. We'll see. I've got a couple open short positions. That's why I put the 30% safeguard. If a stock just starts going crazy and I don't understand why, I just get out of the way. I'm not going to pretend to be an expert in that area. I'm just looking for obvious situations that, like Nvidia, to me, this is obvious. You look at statistically and trend, analysis. This is an obvious parabolic stock. This is a company that's going to replace all other semiconductor companies, and it's going to take away resources and market share from neighboring industries. It's just going to take over. This is like unrealistic. The market has detached the stock price from the true value of Nvidia. Nvidia is a great company, great ideas, best GPU technology on earth, but it's a cyclical industry. And some people will argue that, no, they're not cyclical. And I would say, okay, explain why the company went down 65% in value less than 3 years ago. How do we explain that? That's cyclicality. The company has good years, the company has bad years. So for a company to go parabolic, to me, that's an obvious opportunity. And rather than just making videos and being an investor that says, I think that's wrong, I think the market's going to correct and this stock's going to be worth less in the future, why don't I take advantage of it? Warren Buffett has been quoted that he's seen a lot of opportunities where he could have shorted stocks, but a guy of his stature, he can't short stocks. If he shorted a stock, that company would be ruined. The stock price for that company would be ruined because he's so influential. But he's quoted saying that shorting stocks is a good opportunity in certain situations. So I'm doing it very carefully. All right. So Mike, the dividend investor guy, what do you think about Airbnb still dropping? I did full analysis of Airbnb. The video is going to release at 9 a.m. Pacific. And so Airbnb, the one thing that I think the market didn't like is their earnings were, it was kind of like using the grading scale. It wasn't an A plus. It was kind of a B. Like, it was good. It just wasn't great. And there are some factors that I think investors are considering. One is, the economy. If the economy slows down, we are probably going to see travel. Let me get to the earnings. Here we go. So we're probably going to see travel slow down. I get that. Now, as I've shared on my videos, I do have some insight into their business. I own 2 real estate properties that I put on Airbnb starting in 2012, operated them on Airbnb for 9.5 years. It was very profitable. And I understood kind of like the model that they provide. Airbnb is right now, the most powerful real estate company in leisure real estate in the world. And they don't own any properties. And the reason for it, they're like Uber. They can grow by other owners coming on their platform and renting out their properties, whether that property is in Hong Kong, Paris, France, Morocco, Mexico City, Kansas City here in the US. Airbnb is everywhere, especially remote places where hotels, they can't scale up 1,000-room hotel in a small town. It's like, it just doesn't, the economics don't make sense. But Airbnb can give the opportunity for that small town to put 10, 20, 30 homes on Airbnb and rent it to travelers or people that are going to visit that city for some reason that want to stay more comfortably in a home. The whole model is just a really, really good model. And the experience to the traveler is the best experience in the market. Their competitors tend to be competitors that really are, I call them legacy competitors, meaning they were kind of doing this before, but they didn't do it the way Airbnb did it, and they didn't dominate like Airbnb. So Airbnb is dominating this space. Their addressable market is massive because they continue to grow internationally. Booking is trying to compete with them, but Booking, and you can tell, so Booking used to be Priceline. Priceline acquired Booking, which was smaller than them. And they knew that the Priceline brand carried a lot of legacy liability. So they said, hey, let's call ourselves booking.com. And I did, when I had those properties that were short-term rentals, I did use Booking, and I did get reservations through Booking. 80-90% of the reservations came through Airbnb. And then the rest of the competition took 10-20%. And Booking was good, but they could tell they have a lot of legacy in them. They still book like you're booking a hotel room. Well, Airbnbs or short-term rentals are not hotel rooms. They're full homes. It's more of an experience. And if you stay at Airbnbs, you know what I'm talking about. You can stay, like we traveled, our last, big trip was in Italy. We were traveling to Florence, Italy, and we're staying in a community, and it was freaking awesome. It was great. We'd walk downstairs, grab an espresso, and it just feels different than staying in a hotel. So Airbnb, I'm very high on it. Their growth was 11%. And I think that's what the market's like. Whoa, only 11%, which is not great. Not like record-breaking growth. They're just getting bigger. And the law of big numbers is in play, right? What is impressive is their margin is expanding. They're more profitable. And their free cash flow is expanding. So they're keeping more free cash. I just went over their model. They don't have to buy any properties. They don't have to remodel the properties. They don't have to put CapEx into these properties. They just have to have the best experience for travelers and homeowners, in the business. So their free cash flow was better than I expected. This is why the stock is not doing great, is the growth on revenue isn't great. And they're guiding that it's going to be another quarter like this in Q3. So that's why the market doesn't really like the stock price. Now, that's situational awareness, right? Google Alphabet came out with good earnings. They didn't, over impress the market, sold off. Microsoft came out with good earnings. They didn't overly impress the market, sold off. Amazon came out with very good earnings, and their growth is phenomenal. Then you look at the scale of those businesses, didn't overly impress the market, sold off. So if those three awesome companies suffered, stock losses, Airbnb suffering stock losses, okay, that's what's going on right now in the market. I'm buying more Airbnb shares today at these prices. Thank you, Mr. Market. I appreciate it. I already shared my comments on what I think about Airbnb. Is Airbnb going to be stronger in the future? Absolutely. If we hit a recession, does it put Airbnb at a really vulnerable spot? No, actually, it makes them stronger. You think about the economics. You have a family of 6, and you're like, okay, let's travel to Niagara Falls, and we're going to need 2 or 3 hotel rooms. That gets expensive, and you can't stay together. Well, let's get the suite in the hotel. Now we're getting really expensive, but you can rent a house. You can go to the grocery store, buy groceries, and cook your meals. Probably going to be healthier and less expensive. So as we get into recession, you're going to see that Airbnb is actually going to have strength in the market. As we go into recession, a lot of stories come out where people that own houses, they're like, oh no, recession's here. I'm not making as much money. Maybe I lost a job. Well, I'm going to go ahead and rent a couple of the rooms in my house and operate a Airbnb and just gig for a while just to get through this recession. And I'm going to do it on Airbnb. So that type of behavior begins. And that's what's going to be, I think, one of the advantages of Airbnb versus other business models. So needless to say, I really like the company and I'll continue to buy shares. I think it's a company that's going to really have a big part of the future in experiences. They're also doing something that's pretty interesting where they'll have you do an experience, and these experiences are quite impressive. Like you can have an experience with Kevin Hart. So you'd be a VIP with Kevin Hart. You can go to the Ferrari museum and stay in the Ferrari room, where you would stay in a room with like all these Formula One Ferrari cars. And I think you have to pay like $5,000 a night. You can stay in the Barbie house. Wouldn't that be cool? So you can rent out the Barbie house. You can rent out mansions. So I think that type of experience stuff is going to take market share away or dollars away from companies like Live Nation, where you have concerts and so forth. I think a lot of that discretionary income is going to be going towards experiences like that. And I think that's pretty neat that Airbnb is doing that. I remember they started it and I thought, where's this thing going to go? They started it when I still operated that Airbnb, but you could stay at the Musée, and I don't know how to pronounce that. I'm not French. You could stay at this thing. You could have an experience and have, during the Olympics, you had a VIP area. So that kind of stuff, I think they're bringing celebrities into the Airbnb ecosystem, and that might turn into something interesting. If anything, create really good exposure for the company. So those are my comments on Airbnb. And where is the stock trading? Down 14.8%. I will buy. Thank you. And you look at the stock, like here's what's interesting about the market, right? Now you would think, hey, this is money. Why don't investors like a bond is really good to compare to a stock. A bond, it tells you here's the value of the bond. In 5 years, you're going to be paid $2,000 on this bond. And you're going to buy it for $1,800. So okay, I'm buying it at $1,800. I'm going to get $2,000 at the end. In between, I'm going to be paid 3%. Easy to get your head around. Now, a stock like Airbnb, we just showed that they've been growing their business year after year. But look at this volatility. Up, down, up, down, up, down, up, down. I think if we asked 100 rational investors that were, intelligent about business and said, do you think Airbnb is part of the future? Yes. Do you think they're very influential? Yes. Do you like their profit? Absolutely. I love their cash flow. I love that they're growing. So what's with the volatility? It's because the market at times will misprice a stock. So if you buy here, you can make money. If you buy here, you can make money. Okay. Not quite if you held it there, but I'm willing to bet that this drop is going to be like this drop, like this drop, like this drop, and the stock will rise, is my expectation, because there's only one Airbnb. They really don't have a peer in their space yet. And they continue to create more differentiation and advantages to how they operate their business. So that's interesting. I'll be a buyer of Airbnb. I'll buy at these discounted levels. This is one of my big bets. Turning to Uber. Let's see what Uber is doing real quick. Uber is up. Uber had a very good earnings. Uber did surprise. Look at that. Look at that pop. Very nice. Good job, Uber. So they're up 13.44% in the last two sessions. They announced yesterday before the open. That's another one of my big bets. And these guys are similar. It's a sharing economy. And I think what impressed, and I did a video, I released it, and it's on my channel. The market was really impressed with their growth. and I'm really impressed with it. Uber is clearly separating themselves from Lyft and other companies. The Uber Eats business is going well, but the ride sharing and the potential of someday we have vehicles that are really self-driving due to AI at some point. I don't know if it's 5 years from now, 10 years from now, 20 years from now, but Uber is in a great place where they could take advantage of that and be in a really good place. So that's Airbnb and Uber. We talked about super micro. I think we wanted to talk about hymns, so let's talk about hymns. And so here's hymns, and they looks like they've had a downturn. Now, hymns is, I believe, a healthcare, right? They're classified as healthcare. This isn't going to tell me that, so let me go to this site. And when I've looked at it, one of the first things that I look at is the company. And a lot of looking at the company is both quantitative but qualitative. I have to look at the situation and either believe or not believe. And for me, I think they're classified household personal products, consumer staples. Okay, that's interesting that they're classified there because they really operate as if they were a healthcare company, if they were kind of a generic pharmaceutical company. And I happen to believe that they're really on thin ice in some of their markets. They advertise in a way where you're saying, hey, here's a remedy to this, or here's a substitute for that drug, and so forth. And they're vulnerable to a couple of things. One, people can get sick with their products. And then next thing you know, you got class action lawsuits that are going to really hit your company hard. Two, if you are potentially, infringing on a pharmaceutical company's patent, or maybe, remedy to a patented remedy, you're going to get sued by those guys. So that's going to be a problem. So long and short of it, their growth, I believe, has been really impressive. Their growth is just phenomenal. They are a small company, but this growth is really, really impressive. So that's what is impressive to investors. I look at the space and I'm like, I want to invest in companies that are going to be great for the next 5 to 10 years, potentially. This one's beginning to tank, but I was seeing this and I'm like, yeah, I'm not believing in the business. I think they're more of a marketing company than they are like a healthcare company. And if they're going to compete in these types of things where, skin treatments and so forth, you have heavy competition in that space. You have heavy competition from consumer packaged goods companies like Procter and Gamble. And if you want to go up the price ladder, you have huge competition by all the cosmetic companies. I mean, you got competition left and right. So I really am impressed with their growth. But at some point, you were really paying a big price for their growth. Now, is it now valued, a little better? Is it priced a little? Yeah, it's priced better, but you're still paying a price for that growth. If you look at the 1 year, you're up 75%. It's really tanking. It's not an investment that I thought was something that I wanted to do. Let's look at their cash flow. So cash flow, which is impressive, by the way. It's a small company. They weren't cash flowing in 22 and years prior. So, okay, they just started to cash flow last full year, trailing 12 months, $100 million of free cash flow. Let me look at the quarterly and see what trend is happening within the quarter. So within the quarter, the last quarter was very good, and the other quarters were positive. So again, I'm impressed with their fundamentals, but I'm still not convinced that it's a great buy for myself. If I take that 100, and it's a high growth company, so I'm going to multiply times, like, let's say 50, I'd get to 5 billion. So it potentially is a decent investment if they keep growing at these rates, but it's a little too risky for me. So I'm not convinced the business is going to be around. I think they're one solid lawsuit from having a lot of problems, and their PE is massive. I mean, 206 PE, 85 forward PE. I think it'd be worth, especially as they come down in price, if you continue to believe in the business and you see them operate and continue to grow, and let's say they drop to like $12 a share, I think I would be interested at $12 a share, potentially, if they continue to grow their business. And the quarterly, see, their quarterly is still growing at 51%. Impressive. It is a small company, but 51% is 51%. So that's my comments on HIMS. I would, I'm gonna do more homework on it, but I'd probably be really interested at like $12 a share. When you look at a small company, higher risk. You look at a small company operating potentially in markets where they're going to have big competitors, high risk. So I want my rate of return to be really high on an investment like HIMS. So it'd have to be a high rate of return. Maybe the stock gets really discounted. What if we wake up 6 months from now and HIMS is priced at $8 a share? That might be really hard to pass up. We'll see where it goes. All right, so catch up with some comments here. And Kiter. So I did see the news on Google that search is considered a monopoly, and it is going to affect them. But we have a really good example of Microsoft where they were deemed to be a monopoly, and Microsoft's kept, increasing in value and so forth. They're going to put some guardrails around, Google and their ability to stamp out competition, I guess. But at the end of the day, users are still going to want to use Google search. It's really, really, really efficient. It really gets you a lot of value. So that's not going away. I think for the next 5 years, to me, it's not going to affect their financials. It's not going to affect their business much. There's going to be kind of a growing into it. Could it create another competitor over time? Yes. Does it open up like a bigger window for Google to come in with their Edge product, which is their search or their browser? Yes. So those things are possible, combined with how AI is supposed to come in and compete against Google search. Yeah, those are concerns. They're not big concerns for me. Again, I'm looking at the Microsoft example. That whole thing didn't keep Microsoft from continuing to be the dominant desktop software company on the planet. In fact, they grew much larger than they were back then. So we'll see how it rolls out. The one thing I would say about like ChatGPT, I think it was on the Discord, or it was on one of our video conference calls, this one we had this past weekend. One of the community members said, "Hey, did you know that when you do a ChatGPT query, the same query that ends up with the same result, like on Google search, right? You go on Google search, hey, what is the best, what is the best treatment for whatever, curly hair or whatever. When you use ChatGPT, you use 10 times more electricity, energy than you do Google search. Well, that's going to matter, because if you put the load of Google search, even a quarter of the load, on ChatGPT, the energy consumption is going to be incredibly expensive. So who's going to operate that? And Google search, for the most part, is free to the user. They make their money by recommending things. And the recommendations, they charge companies for, in essence, advertising on search by being placed highly on the search results. So we'll see how that works out. But I did see that. So CVX, so that's Chevron. Yeah, man, oil was looking like it was gonna begin to have a very good year. It's up 1.21%. But if we look at the oil markets, for a while I thought, okay, oil is gonna See, you see here, we're coming out of the summer. Oil is just rising, and it got up to $83 a barrel. I'm like, man, if it keeps going, hell, to $90 a barrel, these oil companies are going to be flush with cash. But then it started to tank. So at $73 a barrel, they still make money. They're just not making like loads of money. So it might not be a bad point in time to buy some Chevron, because oil hasn't gone down much further over the last 5 years. Actually, during COVID it did, but that's a different reason. Nobody is driving to the office and so forth. But if you look at oil prices, they've kind of have had that floor. And if we have an event like this is where the oil companies just load up their balance sheet with like 30 to 50 billion dollars of cash per year. It's crazy. So buying when it's low and waiting for these times is a really good idea, and they pay a really nice dividend. So I'm good with a nice dividend pay out of CVX. CVS. I just did CVS. I recorded the video like 15 minutes before I started the live stream. I haven't edited the video and published it, but right now they're down 2.3%. Revenue went up slightly. They had higher expenses and lower cash flow than expected before. They're guided lower on cash flow and lower on earnings per share. The business I do believe in, as I continue to study the business. Why do I believe in CVS, the business is, so CVS, let's say 15 years ago, was a pharmaceutical company. We all know CVS is the pharmaceutical company, but they acquired Aetna. So all of a sudden, they are a healthcare payer. Now, what is a healthcare payer? And let me show you their financials, and I'll show you what a healthcare payer is all about. A healthcare payer, Warren Buffett famously loves insurance companies because insurance companies collect premiums from policyholders, and then Warren Buffett gets a hold of that cash and starts investing it and makes a ton of money. Brilliant. That's why he loves insurance companies. So our friends over at CVS have acquired an insurance payer. And let me try to find the earnings so I could continue my talk track here. So that's the earnings call. It's just going to get me there. Nope. Oh man, I was just there. So events and presentations. Nope. Why am I not finding? I was just there. Bear with me. See, I could have just asked ChatGPT or Gemini, all these questions and gotten the answers. What's going on? Now my internet's down. 1 second, people. 1 second. So I'll kind of, I think I could show it through here. So what an insurance company does for CVS is, here's their statement of cash flow. And you're going to see big lines in here, and they don't show it correctly. I think the company's financials show it better. And see if I can get to SEC filings. That'll get me there. Okay, so all right. Now we got the data. Okay. So the change of CVS, which I really like what they're doing, is we just don't want to be a retailer. We want to be a healthcare company, and we want to be more valuable. So here are the lines I want you to focus on is cash receipts from customers, $173 billion. Now they have to pay for the services rendered, insurance benefits paid, and so forth. But they're collecting all this money from customers. A lot of it is that insurance money, and they end up producing really high cash flow. This year is down. Last year was far better, and previous years were even better. Now, they are also changing to be a healthcare services provider, which is interesting. And I think that integration of the business is going to make them kind of like a Walmart of healthcare. They're going to be a pharmaceutical retailer, they're going to be a healthcare services provider, and an insurance provider. That could be quite a force, and they could be quite profitable for them. It's just taking them a couple of years to put that together. If they pull it off, the stock can double, triple over the next 5 years. And I don't see anything being super alarming, like, oh no, they're doing this wrong and they're losing money or their cash flows are negative. They're kind of navigating this period of time. The other thing I like is healthcare is not a bad space to be right now. We have technology has led the charge over the last 2 years, but and I'm going to go with the 1 month. But healthcare over the last month has done okay. Healthcare for the last 2 years hasn't performed great, and it's always been a consistent performer. As we head into a recession, healthcare is always good in recessions. So it's good for recessions. It has some pent up upside, I believe, and has always been kind of a good performing industry. So CVS, for a couple of reasons, is going to be a buy for me. And I'll release the video. It'll actually be published in 2 or 3 days, but that's what I've got to say about CVS at this moment. All right, so FTNT, and I believe that's is it Fortinet? FTNT, Fortinet, yeah. Wow, up 23%. Holy smokes. So the first thing they got to do is send a thank you to CrowdStrike for completely dropping the ball and helping them. But I wonder what did they say here? Upbeat earnings outlook. Yeah, I bet. What's their new playbook? Go into all CrowdStrike accounts and tell them how you're better. And ask them how mad they are at CrowdStrike. Okay, cool. Well, one company's misery is another company's opportunity. Here it is. Fortinet. I think the day that CrowdStrike started to have their problems, that's when the other security companies, Fortinet, Palo Alto, they rallied. So that's understandable. The stock is doing well, 21%. But look at this chart here. It's been kind of coming down. Interesting. And their growth has been okay. The quarterly is doing okay, 10%. I mean, this is back to when I was showing you our friends at Airbnb. This is like their growth. As you get bigger, it gets harder, but these guys aren't overly big. So that's interesting that, they're going to take the opportunity to kind of go after CrowdStrike customers, I am sure, and try to take over that market share or part of it. So it's an interesting stock. It's an opportunity at the current time. I did look at the security companies when CrowdStrike was getting destroyed, but I just feel like you're not getting a ton of value from these companies because they don't. Let's see what kind of cash flow they produce. So free cash flow, trailing 12 months, 1.5 billion. So I'd probably say the company could be worth about 45 billion, and they're priced at 51 billion. So not sure that they offer a huge discount right now, and I think that's what prevents me from buying. But this is after a 23% bump. So yeah, it looks interesting. They're benefiting from CrowdStrike's misery. So good stuff. So I think I covered the stocks that people wanted to talk about. As we look at the market one last time here, let's take a look. Market's up, and that's good. That's good that we have a couple updates. I still think that late in the trading day is really going to tell us where's this market headed. If it sells off from this point, like we've been open for 30 minutes, then we're in for a little more excitement to the downside. I think we're going to see further lows. If it sells off today, if it keeps these gains, and heck, maybe even keeps these gains, maybe has a little momentum toward the end of the day. I'm probably thinking this week's going to be a good week, and I'm not sure if we're going to see any further big losses, but we'll see what happens today. I'll be tuning in and watching stocks today. So everybody, thanks for tuning in. Let me just remind you, join the Discord. It's been really good to interact. Good discussion on the Discord, and I hope you guys can join. I put the Discord link on this chat, and I just displayed it there. Join. It's free. A lot of the people on this live stream are on there already. The more the better. That way, if we're talking about a stock and maybe you own it, or maybe you've analyzed it, or you have an opinion, it'd be great for you to weigh in. It's been a really, really cool thing. So join if you can. And just a reminder, I'm just an investor. No financial advice was provided today. Good luck with all your investments, but make all your investments independent of anything that I said. Everybody have a good day. Good luck with all your investments.